Thanks, Alex, and thanks for that panel. And good morning, everybody, and welcome to the first session of the day, which is going to make some of the ambition that we just heard about, I hope, real and practical. Alex, maybe we should talk later about the sort of attitude of asset managers, because certainly on behalf of Schroders, I can say that we absolutely see impact aligned with fiduciary obligation. The reason I say that is because if there's been one trend that we've seen from our client base across the piece over the last, I would say, 3-4 years now, it's really a secular increase. It's this, which is that returns, investment returns, matter. Of course they do. That's our job. That's our fiduciary job. But what matters now increasingly as much is how those returns are being achieved and how we show through the analytics that the panel was just talking about actually demonstrate that we're doing what we say. So I think this does link up. But certainly from my perspective, there's always the question of, okay, so in practice, what do you have to do? How do we make this real? Because the need is abundantly clear, I think, to everybody in this room. And I've just talked about the client appetite, the appetite to put capital to work. But how do you join impact with actual investment return? And that, ka-ching, is what we're about to talk about now. I'm delighted to welcome Shiel, CIO for Big Society Capital, and Mark Bickford from Social and Sustainable Capital, also CIO. Welcome, guys. What we did back in a couple of years ago now was launch the Schroders Big Society Investment Capital Investment Trust, which was designed to do exactly what I've just described, which is join appetite up with actual social impact. So, Anna, turning to you first, can you give us a little bit of background from your vantage point to how the trust came about and what it's trying to achieve?
Surely. And so much what the Trust is trying to achieve builds really on Big Society Capital's experience of making impact investments in the UK over the past 10 years, but also more broadly actually seeking to build and create an impact investing market in the UK, something which has actually grown sixfold over that period. So why did we need to do that? Well, I think we've talked abundantly about the nature of some of the needs and that they need more capital, more funding than is perhaps available to them. So homelessness alone, with almost 300,000 people experiencing homelessness or at risk of homelessness, might need 10 to 12 billion just to tackle that kind of issue. And what we've seen as well is that there is a range of impact-driven enterprises, often charities, social enterprises, many of whom work in some of the most disadvantaged communities in the UK, who are indeed using business models and sustainable revenues in order to tackle some of those issues. They range from those tackling health and social care, education, homelessness, just to name a few. But what we're seeing is that they also need more finance in order to be able to scale up the impact that they're achieving deep in communities and to increase the services that they're providing to often vulnerable people within them. So there's that need for capital. The question was really, how do we mobilize more of it towards those issues? Well, what we were seeing is that there is this growing impact-driven investment market, which is targeting deep and sustainable impact in those issues in the UK while delivering a sustainable financial return. And through the investments that Big Society Capital's been making, so we've committed over 800 million to over 100 investments, working with impact-driven fund managers and banks in order to target a range of those issues, that there is also a diversity of different solutions out there, so different business models, but also different asset classes. To give a little bit of a sense of some of those, there is lending to social enterprises and charities, many of whom, as I touched on, are working to provide health and social care support, for example, to people who may be more vulnerable, or to support people into employment in some of the areas that need it most. Organisations like Schroders, who've taken loans from Charity Bank in order to develop a specialist neurological and rehabilitation facility in Preston. There's also social outcomes contracts, which is a way of financing charities and social enterprises to deliver government commission contracts. And those are in a model where government only pays when the outcomes are achieved. But importantly, they also facilitate and enable those expert charities and social enterprises to provide the tailored and specialized services to people with more complex needs, often in a more preventative manner. So such as young people being supported by West London Zone and supported by the Bridges Outcomes Contract Fund. And finally, high impact housing, which is really about investing to meet some of those gaps I touched on at the beginning around the need for safe, secure, and genuinely affordable housing for people that are most vulnerable. And the Social and Sustainable Housing Fund is a fantastic example of that.
Perfect tee up for Mark, because I think the key here is identifying the right opportunities, as you've just been saying, Anna. So before we come to you, Mark, it would be great if we could just run the video, which just will give you an illustration of one of these projects in practice.
Hull Women's Network was set up in 2004 and its focus is around providing safe housing for women and children fleeing violence and abuse.
When we came to Hull for the first time, it became clear to us how dismal the statistics were surrounding domestic abuse.
1 in 4 women at some point in their lives will experience a violent relationship. Specifically in Hull, we know from police statistics that at any one time there are 25,000 women and 19,000 children who are living in a violent relationship. So what we're able to offer at Hull Women's Network is a route out of that.
What hadn't been clear to us until we got here, and it was explained by Lisa and the team, was that actually a lot of the reasons that women return to violent partners is just because they don't have somewhere safe to live. And it felt to us like a relatively simple thing that could be done to ensure that women and children could escape ongoing pain and suffering. So when we left after that visit, we were highly motivated to try and find a way to connect our capital to allow Hull Women's Network to build a portfolio of safe and secure houses.
Safe accommodation is a basic human need, and it's the thing that helps women to restart and rebuild their lives and recover from the trauma of violence and abuse. And they can stay there as long as they need to and move forward emotionally because they don't have to worry about where they're going to live.
Thank you. So, Mark, I mean, clearly a fantastic project in its own right. Can you give us a little more of the background in terms of how it came about, and in particular, from your perspective as an investor?
Yeah, thank you, Charles. So, our journey in social investment has been entirely different than the one we imagined when we entered the market in 2013. So, most of the people at Sask are from a banking background, and we came into the market thinking our success will be completely driven by what we can teach charities about finance. In practice, it's been the complete opposite. It's been all about what we can learn from them. So when we met Hull Women's Network in 2016, we offered them what we had on the shelf at that time, which was basically a high loan-to-value mortgage. Lisa, who you saw on the film, told us, sorry, not good enough. She sent us back to London with a big shopping list of issues that we'd have to resolve if we wanted to work with them. So we took the list away, and with plenty of iteration with the charity, we came up with something that we called at the time our whole property finance loan. Lisa liked it, and we lent £3 million to Hull Women's Network to buy 38 houses. We then road tested that product with a number of other supported housing charities. That process went really well, and so it then became the basis for our housing fund, which we launched in the summer of 2019.
Which, just like any other fund, therefore has diversification in it through the underlying projects.
Exactly, yeah.
And in terms of broader lessons that you've learnt from applying that process, what would you tell our audience today?
So if I think about the success of our housing fund and what's gone well, for me it's down to two things. Firstly, it was a genuine co-design. Now, I know that's a phrase you hear a lot these days, but honestly, without the challenge and the insight from Hull Women's Network, it would not have happened. And secondly, it's about risk sharing. Now, we don't have time this morning to go into all the features of the fund, but at its heart is a much more equal sharing of risk between borrower and investor than you would normally see with mainstream finance. Now, those risks obviously have to be specific, they have to be well understood by all stakeholders, and they have to be properly mitigated. But the good news with this approach is, if you do it well, it results in a much more effective deployment of investors' capital. because you're designing something you know the market's going to want.
And they're owning it as well, I think, is what I'm hearing you say. It's one of the core things which I've just heard you say, I think, which is that one of the traps to emphatically avoid is to go out all preachy and say, oh, here we are, this is what's good for you, we know best, as opposed to actually devoting the time to properly listen and then come up with something that is, as you say, co-created.
Yeah, and we did that. For the first 3 years, we did that, and it wasn't great. You know, we did not deploy very much money.
Top marks for honesty.
Yeah, until 2016. So for us, being a social investment fund manager is about identifying the things that worry charities about taking on finance to expand, the things that stop them doing more, and then working out whether you can absorb some of that risk and package it in a way that still makes sense for investors.
Right. And picking up on that theme, Anne, if I can come back to you, you talked about the different categories that you look at today. Could you bring to life, again, what I'm trying to do is to make impact seem to everybody as being completely normal investment. And so with your kind of pure investor hat on, when you're looking through the lens of investment and risk and return and diversification, bring to life a little bit in terms of the actual portfolio construction technique that you apply.
Surely. And I think what Mark's actually talked about quite eloquently demonstrates something that's really fundamental to that, is actually how starting with a social issue and working in partnership with expert charities can actually underpin both that risk and return on the financial side as well as the impact, and then also the diversification. So for us, as I say, we've started with a social issue in terms of identifying the nature of the investment opportunities and then subsequently the asset classes that we're investing in. And building on that has actually allowed us to stimulate and work with other partners in order to support the growth of those different asset classes, whether that is social property funds developing to a sort of £3 billion market, or the growth of impact venture. And of course, all of those have different characteristics in terms of both the impact they offer, but also the drivers of their business model, which is often related to the impact. So actually integrating impact into the decision making helps us make better decisions actually about the financial risk and return. But what that's also catalyzing through that breadth of different products and those different drivers is obviously a range of products which mean different investors can access different solutions which meet their own individual risk and return characteristics and priorities. But it also allows us to construct portfolios which are diversified across impact, across risk and returns, and also often not correlated as much to each other or to mainstream financial markets.
I think that's a crucial point to draw out, that that very lack of correlation. I mean, you said two things there. One is the ability to customize where necessary, and coming back to my opening remark about how my returns are being generated, and then secondly that's specific angle around risk and return and lack of correlation. The trust is obviously a way of harnessing long-term capital, and the panel before talked about the combination of public and private. Do you feel that the trust is a good way of accessing?
Absolutely. So I think what we were seeing was that, as I've touched on, the investment opportunities are there. They are tackling these entrenched social issues, and they are targeting sustainable financial returns. But they're perhaps harder for institutional and other investors to access if you don't necessarily have the specific expertise and impact of the deep networks. So essentially, the problem that the trust is sort of tackling is bringing those together in a diversified portfolio of predominantly what are private market investment opportunities, and doing that through the medium of a listed vehicle.
Yeah, I think, and that's the joy of it, because on the one hand, you've got access, as you just put it, to private opportunities with a longer duration, and yet it's a listed vehicle which affords a level of liquidity to end savers. And I think that, again, in terms of the call to action for the room, in the sense, that's where it's the art of the possible here, which is what this trust is achieving. And Mark, from your point of view, I'm guessing there are just no shortage of further opportunities. Bring to life your current dialogue with charities?
Yeah, so...
Or is it, and also indeed, is it just charities or is it beyond?
It's mainly charities. The landscape in supporting vulnerable people is the market we serve is mainly charities. There are some community interest companies, if people know their different legal forms in social investment, but it's mainly charities. There's so much demand out there. I mean, domestic abuse is a very good example. I mean, that's increased immeasurably during COVID. And we all saw with Everyone In and the rough sleeping initiatives, there's plenty to tackle. And we have a pipeline of 30 charities that we're currently talking to, which, based on the averages of our first fund, will run to somewhere around 90, 100 million pounds of deployment.
Thank you. Well, it's probably rather a good note to end on, because the call to action is clear. The level of need is unambiguous. But to repeat our theme, we're dealing here in the art of the possible in terms of joining up long-term investment capital that is increasingly interested in being seen to understand the impact that it's having with the origination opportunities, and doing that very closely in partnership. So with that, Mark and Anna, thank you very much indeed. And I would now like to introduce Richard Fuller, who is Economic Secretary to the Treasury, for our next section. So thank you, everybody. Thank you.